Folks, I am not kidding. There is a number one resource, a free number one resource that not enough of you are taking advantage of, and that is Resi Club. You need to be going to Resi Club Analytics to get the free stuff. Lance Lambert, you are the creator. What do you got? Show us what is possible because I don't think people understand the
Yeah,
stuff that you
housing,
can do.
housing, housing, always a lot going on. And so what I'm doing now is I've left Fortune and I built my own publication called Resi Club. And I have a newsletter where there's a free piece every single day of the week, weekday. And it's like some of the biggest stories happening in residential real estate. And they're still jam-packed with a lot of data and a lot of great interviews and a lot of great stuff. And then I have a premium one, which is 3 days a week plus access to more of my data. So let me share what this daily newsletter looks like, or the content at least. And so you can also find it on resiclubanalytics.com if you go to my site. And let me just share it. So the first story that I did was an update on inventory across the country, but really it was also a piece arguing why inventory just matters so much. And I think if somebody were to read this, I think they could get a gist of it, even if they hadn't been like super absorbed into residential real estate. So if you got this issue and you wanted to kind of like forward it on to somebody to kind of explain how to read inventory data,
Yep.
this explainer would be perfect. And so it shows here's where national inventory is right now, just a hair behind 2023, but still very, very low. But we are starting to get some late growth beyond seasonality, but still fairly low relative to pre-pandemic levels. This is across the country. You can see that most of the country is still 40-50% below pre-pandemic
Wow.
levels.
That's people don't understand. People don't understand that chart. That chart is shocking if you're
And
a
then
first timer.
And then I love this one, which is year over year inventory change, 2 year inventory change, 3 year, 4 year. So 4 years since pre-pandemic.
Yeah.
Only Austin is up above pre-pandemic among the major markets, which is also the market that's cooled down the most. And if
Well,
you
I
look,
just want to hit. I want to hit that one more time because again, if you're out there, you're just an everyday purveyor of real estate, and you get addicted to crash porn and doom and all of this stuff. Supply matters.
yeah.
If you want
So
to understand why Austin has seen a 10% or 7% or whatever it is drop, supply matters. This chart shows it.
So one thing I would do if I was looking at my market is I would take the same month in my market, whether it's zip code, county, whatever,
Mhm.
take the same month from 2019. So in
Yes,
this case, September, take it, and then you'll have the new month now. So you take the new month, divide it by the old month, -1. That's your percent change. You could Google a percent
exactly.
change calculator, but find the percent change in your market. If it's closer to it, it's probably a little bit of a weaker market.
Yeah.
It's really far under. That's probably putting you into a place where next spring, let's kind of see. There could be
Yeah.
some top.
Look at San Diego.
San Diego's actually been San Diego
Wow.
is one of the craziest markets in the country because when the shock occurred initially last year, moving from 3 to 6, San Diego gave up on prices kind of quickly.
Yeah.
Now, there was so much inventory and there wasn't many transactions occurring, but it gave up on the few transactions that occurred into the bottom of the year. This year in the Case-Shiller 20 markets, it's up the most. They're like
Yeah.
up 8-9% year to date. So they've already set a new peak for the market or right around it.
Yeah. I want
But
people to hear that again. I read an article. It's funny this week about San Diego being the most competitive market or whatever they called it. And it's because the transactions are setting record lows, but appreciation is up. To your point, it's up 8%
yeah,
case short.
and it goes back to what we talk about all the time, which is the supply and demand curve.
Correct.
You can have higher or same appreciation on very few transactions, depending on where the supply and demand curve pulled back to. And
Exactly.
if demand pulled back further than supply, you could have more growth still. Now, if you're a market like Austin, where the demand pulled back so fierce that then that's what created active listing growth as things sat, then of course, your supply and demand curve pulled back a
Yeah.
different way. So you can give up some on prices.
Yeah. And
Uh,
folks, again, he's giving this stuff to you for free. This is
yes.
all free. This is pretty wild.
And then short, quick hit yesterday. This is about mortgage rates. going and setting a 23-year high yesterday, and mortgage purchase applications that came in yesterday for last week are the lowest since 95.
Wow.
Quick, what's happening is pretty much we're going into a Q4 housing transaction deep freeze, just like
Yeah.
last year, essentially.
Yes,
It's not going to be
exactly.
many transactions. And what happened is mortgage rates spiked, combined with seasonality. We go into a deep freeze for transactions.
Agreed.
You go further into the piece, it explains that, housing affordability is so pressurized right now that there are fewer resale transactions occurring than 08. But don't confuse resale transactions with house prices. Prices are relatively stable. You'll see an ad. That's how I make my money on the free one.
Yeah,
And
makes
then
sense.
one thing to consider is that existing home sales are currently constrained due to suppressed demand and supply. There's simply as much churn occurring in the market, i.e., someone selling their home to purchase something new. This is understandable. Essentially, many homeowners are hesitant to sell their properties and buy something new because of the financial shock of losing their low interest rate for something with a 7 or 8 handle. And then it goes into like 5 things I'm keeping an eye on for these last few months. Does active listing growth continue beyond October? Like that was just greater than expected market softening. 2, builder confidence is down a bit. Does that translate into builders slashing margins a little more and even sweeter incentives? 3, how much price softening occurs? There hasn't been much outside of markets like Austin and New Orleans this winter, but probably a little bit of softening here. Where are mortgage rates come December? I think that's important as we start to move into the seasonally stronger window. And this is where is the key housing market metric come December. And I'll share that in a second, what that metric is, but that's for the pro members. And maybe just one more here on the free, just to kind of share the robustness of the data. Investors are pulling back from markets like San Francisco and diving into places like Indy.
Yeah, I
San
thought this was
Francisco
I thought this was a great article. Again, folks, this is the best place to come for free stuff. I read the articles. It's a part of my daily financial news. This chart specifically is so eye-opening, and I can't believe you give it away for free.
these places barely cash flow before. Like
Yeah.
there's no, I mean, it's part of your story, right? You're
Yep.
in the San Jose market, couldn't find much after a year. I
Yep.
remember in your book, and then you kind
Yep.
of were looking around, and then Fresno.
Bingo.
Well, it's just that it's even worse now because
It
rates
is worse now. Yes.
just
It's
there's
just
just not
dumb.
much cash flows. So for every one investor pulling out or buying in San Francisco, there's almost 2 selling. So there's an exodus occurring of investors.
Yep.
The opposite, Indianapolis, Philly, Denver, Milwaukee, New York, Nashville, Charlotte, Jacksonville. For every one investor selling, there's almost 2 in Indy buying.
Yeah, actually, it's funny you bring this up because I talked about Milwaukee the other day, thanks to some data from Resi Club Pro. But Milwaukee is one of those markets that it's getting a lot of investor focus, and this number
Yeah,
just jumps off the page.
it's overheating. It's
Yeah.
overheating a 7-8% mortgage rate environment.
Yeah,
Uh,
crazy, right? 7,
yeah,
8% mortgage rates, it's overheating.
Yeah. And the part of it is there's still money in the economy and it has to go somewhere. And it's going to go to the places where it can find yields. And right now that's Milwaukee, Indy,
Yep.
in Philly. One thing to keep in mind is anytime that I do data and I call out a market, unless I say city, I almost always mean metro area.
Correct. Yeah, people need to know that.
And I think that's important because some markets like DC have been super resilient as a metro, but
Right.
DC proper is actually seeing good price give
It's
up.
got hit. Yeah.
Yeah.
Or up.
Yeah. Prices down in the
Yeah, that's
city
what I thought. In the city,
for the
yeah, down it.
metro. Yeah.
Yeah.
Yep.
Very good. Well, now let's give them a taste. So this is all free. Now show people how they get part of this. They put in their email address, as I recall.
Yes. So you go to Resi Club and you just put in your email right there.
Yep. There you go. Subscribe, and then they'll be added in the evening, and they'll get the report tomorrow.
Yeah. Yes. For the free. Yes.
Yeah.
Now,
That's
if
how
you
it
want
works.
to upgrade, once you put in the free, there will be another page that comes up. So let me see if I can do it. It's not wanting to take my email again. Let's see.
Yeah.
Maybe it will now. Okay. So this would be the pro. And what the pro is, this is the paid version. The free gets 5 issues a week. The pro gets 3 additional subscriber only articles. access to my Lance Lambert regional housing tracker data. Here's where I'm going to put more of my interviews with like some of the bigger names, like the CEOs in real estate, and then my subscriber only Resi real estate rankings.
Nice.
So let me share. Okay, so here's actually, give me a second.
No problem. Take your time.
Let me share. Yeah, I'll share yesterday's. So this is this is what I consider the key metric to watch if you want to just figure out very quickly where your market is relative to others and how the strength is.
Okay.
And it's essentially the 4-year change on active listings. And what you'll see if you zoom out and you look at this chart is year-over-year price shift for the 400 largest markets in the country.
Interesting.
So everywhere above this 0, prices are up. So the majority of the country, prices are up this year. If I had to say nationally, we're like right around here, but prices are up. And then these ones below 0, prices are down.
Okay.
Then this bar is active listing shift since 2019.
Oh, look at that.
Everywhere to the left of this cursor right here, the 0, are down for inventory.
Wow. So let me just repeat that. What this is telling me. This is telling me that Hartford roughly is up 10% year on year in price and down in inventory, call it 80%.
From pre-pandemic levels, yeah. And then Austin is down 10% year over year on price, up 14% from pre-pandemic levels. So what you will see is there is a actual statistical correlation that's fairly strong for active listings from now to 2019 for price growth. And I kind of expect that to continue into next year. It was the case before this 12-month window by a little bit still, and I think it'll continue to be the case. And actually, I don't mean by a little bit. Actually, if you go back and look at 2021, 2022, the markets that were down the most from 2019 levels saw the most price growth. And that was in 2020. And the reason is active listings is not just a measurement of supply, it is the balance of the market. Everything kind of comes into it. So active listings can grow without supply coming in if demand pulls back really fast and it begins to climb, as long as there's not a lot of delistings happening. And that's what's happened in Austin. And then, Hartford, still for every 4 homes available for sale in 2019, there's only 1 now.
That's amazing.
Dramatic. And I think a part of it is the donut effect, where there's still a lot of people searching for affordability outside of the New York metropolitan area, that a lot of Connecticut, New Jersey metros are enticing for them.
That's amazing.
I really like this one. And so this is for the pro members. And a reason that this data is so important is that one thing that's happened during this deteriorated affordability environment is that the rules of thumb of real estate don't apply as well right now. So normally anything for 6 months and under for inventory of supply is a seller's market. Austin house prices started falling when there was about 1.92 months of supply.
Wow.
Austin has only gotten up to, as of last month, 3.8 months of supply, and they've gone down 17% on price. And that's why you have to have these clever measurements and look at the speed of the shift too. So I'll share some of that as we go down further. So here is a chart for and let me see how many I did on this. Okay, 50 markets. It's 1-year change, 2-year change, 4-year change, year over. Okay, so this is inventory shift 1-year change, inventory shift 2-year change, inventory shift 4-year change. Then here, after this black line, is year over year home price growth, price drop from peak. Austin is up 130% inventory over the past 2 years and is up 14% on a 4-year. And they're down 17 from peak on price and down 10% year over year. And so one thing I think is really important with this one is that you will see that a market like Austin, they're no longer racing up that fast for active listings. They've kind of
Hmm.
they took their initial hit and now they're kind of chilling out. What
Mm.
you are starting to see is that San Antonio and Memphis and New Orleans are
Yeah,
weakening. They've been
they're
weakening.
coming. Yeah.
Yeah, and if you've been following some of my stuff I've been posting, San Antonio and New Orleans are starting to see some price declines that are bigger than seasonality, around
Hmm.
1% month over month. So
Yeah.
there's weakening occurring, and it's interesting because they didn't see as much a weakening last year when the towns like Austin and Boise were giving up.
Mm.
So I think that's really interesting. And one thing, you're kind of in the camp that calls this more of like an 80s housing market. And I think
Correct.
one thing to keep in mind in the 80s, and I got some recent data I saw on this, is
Mm.
throughout the entire decade, at any given time, about 15 to 20% of markets were down year over year. So
Correct.
that's like one of the more normal markets where there was lots of different regional divergences and things happening, but
Correct.
national prices kept climbing the whole time. I mean,
Yep.
Austin, Boise, I'm not Austin and Boise, Austin and Houston and some of those Texas markets, they saw almost 30% peak to trough declines in the 80s. But that was
Correct.
also SNL and an oil
Hmm.
bust, which was super unique.
Right.
But
Well,
one thing,
that's a good point. I want people to hear that again, right? I talk about the 80s. I always highlight the 80s that prices didn't go down, at least in nominal terms, and people lose their minds. You're absolutely right. The 80s had housing markets that corrected and some crashed, right? So
yeah,
you can have regional variables. But again, my conversation, my thoughts of basically being flat in very much the 80s is national numbers, right? Do your work, know your buy box. Follow Resi Club Pro because you give everybody the data. It's updated. You have this data source that is just amazing for folks. They need to get it.
well, and so one more thing I wanted to get to is these markets here for the year over year
Mhm.
inventory shift. Nationally, inventory is about down 3% year over year, but we're
Yeah,
kind of getting close to back to where it was.
sure.
Detroit, Philly, Boston, Cleveland, I mean, look at San Diego.
San Diego's down 37%. I can't
Yeah.
believe that.
So nationally, I would kind of describe this as a bit of a sideways move,
Yeah,
right? Kind of sideways up right now on price-ish
sure.
looks.
Hmm.
That is not going to be the case on a regional basis either.
No,
There's
agreed.
going to be places where 10% pops, you know.
Hmm.
I mean, Hartford, I mean, Providence up 6.4% year over year, Chicago up 5. And this is given, and this is in an
8% mortgage rates.
yeah. So I think it's really important to watch this column, which
Yep.
is the 4 year change on inventory, and then
Yes,
also the 1 year. I think
totally
both of them
agree.
are important.
Very cool.
And
Well, this is
and one
amazing stuff. Go
one
ahead.
more thing, I don't want to keep it too long, but
It's okay.
uh, Resi Club's Pro subscribers also get access to my inventory trackers and my price
Yeah.
trackers. And so I shared this last week, but it's active listings, new listings, days on market, same four categories, all by metros across the country. And each week, this is going to get more robust.
Hmm.
Right now, there's like 250 metros in here. Next week, it's going to be 800. Then I'm
Oh, wow.
adding counties. Then I'm doing zip codes. And then it's going to go to price. And I'm going to build my price trackers.
Ooh,
So
are you going to do the whole like bottom tier, upper tier, that price tracker?
I could do that. Yeah. Did you see the week the
I
pro?
did. I did.
Okay, so
Yeah.
you got to
I
see it.
love
Yeah.
because that's a lot of analysts talk median price and national and all of this, but you've heard me talk about price points, right? Luxury versus entry level. That's what's going on. And I think the fact that you're going to bring that to Resi Club is game changing. Nobody else talks about it. Um,
Yeah.
that's important. I saw this earlier in the week. It was awesome.
Well, yeah, let me just get it so I can tease it a little bit so people could see it. Where are we at? Okay.
There you go. That's the one.
Okay, so here is the price shift in the lower tier.
Mhm.
And what you will see is there is a lot of places throughout the Midwest, Northeast, and into pockets of the South and New Mexico that are up.
Double
Oh,
digits.
yes. Oh, yes. This year. That's
Yeah,
crazy.
that's
Yeah.
nuts.
And then if you go and you look at the upper tier, you will see out west there's been more declines on the upper tier.
Mhm.
And then there's been like no gains on upper tier
Yeah,
across the country.
yeah,
So upper tier, like no gains, but more declines out west.
yeah.
But this increase on the bottom tier in the Midwest, Northeast, and other pockets of the country has been enough to cancel out all the declines and still have us up a little bit. So
Correct.
it's just a very bifurcated market, and I could share it here.
That's the chart right there, baby. That one's amazing.
Anywhere where orange is to the right of green, that means that upper tier prices are down or have less growth than lower price tier in that given
I
market.
mean, look at Seattle, for example, the third one.
Yeah, -5 for the lower tier
Yep.
and -12 for the upper tier. And
Yep.
actually, that's rounded up to 5, and that's
Sure.
rounded down to 12. So the gap's
Mhm.
actually a little bigger. But
That's
yeah,
amazing.
it's across the country. New York, the metro, at the bottom's up 3, and then the top's down 2. There's a
Look at
lot that,
that.
yeah,
And then again, this is something I've been bringing to my audience for a while. If you happen to be lucky enough to shopping in luxury market, it's time to get a deal. But yeah, entry level, nothing there. It's hard, competitive, bidding wars. It's the market we're in.
yeah. Well, thank you again, Michael, for having me on. And I love talking to the one rental at a time audience.
Yeah.
And if anybody wants to subscribe, especially for the free newsletter, it's resiclubanalytics.com. If you can't find the URL, just go to my Twitter and you'll see it on my
Yeah.
page.
Resi Club Analytics, folks, if you don't go right now and go get the free stuff, I don't know what you're doing. Anybody who follows me on One Rental at a Time is interested in housing. I read his stuff every day. I I don't know why you don't go there for the free stuff. And if you're really serious, the pro membership's a joke at like $12 a month or whatever it is. So, sign up. Let's go. Thanks, Lance.
Okay.